Let's get some hard numbers on a consumer business. I believe it was an interview with the FT. You said the following: a market share in consumer, 12, 13, 14%, depending on who counts. The reality is you could double that.
Right.
Do you want to double that? And when?
We want to drive it forward. The context of that was, are you too big and do you have to go outside the United States to do something? And the answer is no, we don't. There's such opportunity in the United States because even though our market share is high, in the top 30 markets in the U.S., we're the top market share in retail banking in 12 of them. The nearest, I think, is 6 next to us. But the reality is, up until 2 years ago, we weren't in 7 of them. So if we just fill out those 7 to be like the other markets, that's a lot of growth, and we can do that all over the U.S.
You could double this organically.
The context is we have gone from probably 10 to 15% across the last few years, and so you can think of this as a challenge to my team and consumer. Get with it. Let's double it. But the reality is, it's a response to how much opportunity there is in the United States left for Bank of America.
For years, you've talked about responsible growth. Let's talk about the leveraged loan business. Almost every week, there's a new shop with concerns about leveraged loans. You've got great insight into this area of the market. Walk us through what you're seeing at the moment.
Well, in the end of the day, going back to Tom's point, over-leverage is over-leverage is over-leverage, and when the economy slows down, those companies are most exposed. That's banking 101. The reality is our on-balance sheet exposure in those things is measured carefully. It's very low, very low. The real question for the economy and what through different groups they're talking about is a lot of it's in funds and other types of support, and what will happen when those companies don't fare well? Will those funds work with them the way the banks would work with them in terms of working them out, as opposed to just closing them up? The other question is, in a net asset value context, i.e. their liability structure moves down with the assets, that feels good at the moment, but when you trade it from that person at 60 cents on the dollar, next person, what's the next person do with it? And those kinds of questions are open, and what will be the impact on economy? Our actual leveraged lending is a very small part of our on-balance sheet credit exposure.